And the key point about its business, that net bookings were up, applying 9%. It's just put out a trading update, half-year trading update. Been driven by more growth in Asia and Central America. Unfortunately, those regions, they're not paying as much, but it's still growing. But it's the cost of acquiring customers is falling. And direct marketing, these are scary numbers, direct marketing as a percentage of revenue has fallen to 45%. Now, that's still staggeringly high.
Yeah, it is.
But 45% is down from 51%, and it was even higher before. So it's been spending huge amounts of money on online marketing. If it can crack that and spend less and less, obviously the margin expansion is terrific.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM, and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hello, Lee. Good to be here after a cracking England result.
Yes, really good. Very happy. It's nice to see us in another final, and fingers crossed this is the one.
And having played decent football as well for a change. Really attractive football.
Yeah, first time in the tournament. We had our luck, the penalty decision. Hey, we'll take a little bit of luck here and there.
Yeah.
So anyway, we'll get started on the podcast. And the first topic is some more good news, actually. The UK economy has grown at 0.4% in May, which is better than expected by most economists.
Yeah, it's nice, isn't it, for the new government to be attached to this? They've been in a few days, and look, the economy's growing 0.4%. So timing is everything. Good news, but risk on the other side is with the economy growing a bit faster than forecast, the Bank of England now is perhaps a bit reluctant to cut interest rates. According to the experts, they estimate now a 52% chance of an interest rate cut of the next meeting, which is on the 1st of August. And that's down from a 60% chance. So now we're broadly 50-50 on an interest rate cut. So, yeah, economy's booming, but is it getting overheated now? We're getting overheated, so that's going to hit the likelihood of interest rates coming down. You can't win everything.
Are we just now at the new normal? Is this what interest rates perhaps always should have been?
Yeah, probably they're a bit higher than normal, but yeah, they're not going to alter too much from around these levels. What are we going to lose? 1% tops?
Yeah.
I don't know. I don't know, but
yeah, I'm sure many of our listeners are well aware of what 0% interest rates has done. It's distorted a lot of markets, hasn't it?
Yeah, it certainly has. And I think we could lead on to that actually with the final company we're going to be talking about. So we can mention the impacts of zero interest rates environments on them. So worth remembering that for a final business in this.
Yeah, and that company is actually a new listing on the stock market, Melrose Industries, which segues quite nicely into this next talking point, which most definitely will have an impact on pretty much every investor listening to this podcast. And that's the new rules that the FCA has just greenlighted around listed companies. And this has been positioned as one of the biggest shake-ups in listed companies for almost 3 decades. So it's quite a significant change in the rules around founders and private equity, and it certainly will have an impact on private shareholders, won't it, Chris?
Yeah, I didn't know it was coming to such an extent, but effectively these new listing rules, these are for the companies listing on the stock market, will hand more power to company bosses to make decisions without actually going to the shareholders in a vote. And this is conceivably going to encourage founder-led businesses where the founders want more control over the process and the running of their company. They want to retain more control. And they've made, for example, founders may have been reluctant to list on the stock markets because they didn't want to give up their control to outside holders. Well, this will give them more control, but importantly, it also gives more control not just to founders, but the rule changes are now affording more control, for example, to the private equity holders, for other general shareholders, and not just founder holders. Yes, that's good because we need to encourage more listings. That's key. And the US market, for example, has afforded this kind of flexibility. The likes of Alphabet have other classes of shares. Warren Buffett's has A shares, B shares. A lot of companies have these dual classes. So from that extent, it's encouraging. But is the risk here that we're giving too much flexibility to founders? It could be the return as a Wild West kind of thing. That is the fear, and the regulator has pointed that out. The regulator has warned that this is the case. Is this too flexible? Is there greater risk with this? So they are spelling it out. So, yeah, we will see. I think it's bold, should we say. It's a bold move, and I think the current state of the UK market, stock market, demanded bold moves. So in a way, that's good to see.
Yeah, and it's worth noting now that this is something that has been going on since May 2023, started in the Conservative government and is, by the looks of it, going to be continued by the new Labour government as well. We've mentioned previously, haven't we, that we do think there needs to be a shake-up the way that in the London listed market to help encourage founders and founder-led companies. So I suppose in that sense, this is a positive step forward. As an investor, as a fund manager, what do you think about this, Chris? What's your thoughts on it?
Yeah, I'm not convinced. The main sort of focus should be to attract more interesting companies. This is really going to attract. Is this going to attract the companies who will also in turn believe they're going to get better valuations, get a better hearing on the UK stock market? I don't think that's necessarily the case. Is it going to change the mind of, if a founder wants to list and he's going to get his business is going to be valued at $1 billion in the UK and conceivably double that on the US? He's going to be inclined to go to the US or somewhere else. And is it going to attract the wrong type of companies? The fact that it affords private equity firms and venture capitalists that they may be able to hold more voting rights than other shareholders for up to 10 years, is that going to attract the wrong kind of businesses? Your corporate types, your corporate financiers, not your real entrepreneurs that we should be looking to attract. So I'm not convinced. The aim itself, the market, London's growth market, the junior market, where we invest a lot as a firm, as in Fundamental, that's always had a lot of flexibility in terms of the percentage held by founders the remaining held by founders in their companies. And that's really ended up with some disastrous scenarios in the past. Yeah, I'm not convinced.
One of the statements here, the new listing rules will hand more power to company bosses to make decisions without shareholder votes. That's a double-edged sword, isn't it? As you just pointed out there.
It is. You've got to have company bosses that are fully aligned and embedded in the culture of the business. And are they truly well aligned with these dual classes? To be seen. But they need to do something bold. This is a bold move. Let's see how we get on.
Yeah, agreed.
It's a case of let the buyer beware again, isn't it? You do your work, you do your research, you check it out, and investors make their own minds up about this.
Yeah, it is. It comes back to that fundamental rule: do your own research, doesn't it?
Yeah, it is. It does indeed.
And do you think that the new National Wealth Fund that the Labour government has announced, do you think that in tandem with this could be a good contributor to seeing growth and new companies coming to the stock market?
It should do. Look, its primary focus is on electric vehicles, clean steel, improved ports. So big infrastructure stuff it's really addressing, isn't it? But there's going to be a drop down, surely, into the smaller end, the niche providers, the picks and shovels, I think, have you alluded to before, the providers of support services. So that's all good news. There's more funding in the system, and that should benefit and drop right down to the bottom, hopefully. So I think this is just another piece of the jigsaw. So great. Yeah, bring it on.
So you're happy with the Labour government so far then, Chris?
Oh, I'm delighted, thrilled. We needed a change. We're in the final of the Euros. It can't be bad, can it?
Yeah, brilliant. Can't get any better. Yeah. Should we move on to some company news now then? Carlsberg, we've mentioned, was it last week or maybe the week before? They were looking to buy Britvic. And you did say, watch this space, that they'll be back. And it looks like they have come back.
Yeah, they come back with a bigger offer, and it seems that's acceptable to management of Britvic and conceivably shareholders. I assume they've all been consulted. Carlsberg, it's already got the approval of PepsiCo, who Britvic bottles for in the UK. Carlsberg's also PepsiCo's bottler in Norway and Sweden, Switzerland, etc. So there are always those arrangements. That's done, and yeah, it looks like that's going to go through now. It'd be a shame. Britvic goes back to the 1930s. Chemist in Chelmsford began producing soft drinks. So another old, well-established business that had just started to really get going again is now going to disappear from the London stock market, which is a bit sad. I prefer to see Britvic being the acquirer rather than Carlsberg. But, it's a classic case of the giant snaps up the mid-cap, the UK mid-cap.
Yeah. And speaking of small caps and AIM companies, shall we move on to our leisure and travel week? Starting off with Jet2. Record profits and more planes on order.
Yeah. Jet2 just announced great results. Year ended March. Revenue was up 24% to £6.2 billion. Profits up 43% to 529 million. It's a huge move, all right. It's just coming out of pandemic year as well, or post-pandemic. but it flew 17.72 million passengers. This is big. This is a big business. AIM's largest company by market capitalization. I think, barring a one-off return from Burford Capital, I think these are by far and above the largest profits that any AIM company has ever produced.
Wow.
529 million pre-tax. I think it's well above any other company's achieved. Let's say Burford Capital had a one-off big booming year. This is staggering. And on paper, the rating this business looks really cheap. It's trading at a sub 8 times P multiple for the next year. Evidently, there are risks, there are concerns. As you said, it's got an order in for large number of new Airbus planes, but that'll improve its cost base, its efficiency, its fuel efficient. They're much more fuel efficient, so more efficient to run. But yeah, they're going to be spending over the next, I think, 6 years, they've said 5 billion. Net 5 billion capital expenditure on these planes. Some of it's going to come out of their own cash, and other bits they're going to lease and have debts to acquire them. But yeah, this little business is great. And it's ignoring all the financial measures. What this business has is a great proposition, a great offering. Yeah, its Trustpilot ratings are terrific. It's highly regarded across it. All the reviews are generally very positive. Miles better than, say, the EasyJets, the Ryanairs, the Wizz Airs. Clearly, it's mostly about package holidays, but it really has a good reputation. The fear is it's a bit cyclical, boom and bust. People say never buy an airline. But this airline has demonstrated year after year that what it does really well. We're shareholders across our AIM book, Fundamental Asset Management. The quick key question is, how big can it get? It started flying from its Liverpool base, and it's got a 12th base from Bournemouth next year as well. So it's coming into the southeast a bit more. But how much bigger can it get? It's added more destinations in Europe. As I say, and the fleet's going to grow from 127 currently to 100. It's got 146 ordered. That's a lot of planes. Billions and billions of pounds going out. But this business has proven itself for a long time. And as I said, ignoring the financials, when a company's got a good service offering and its employees seem to stick around as well, it looks after its staff, which it has done, which it did do over the pandemic, far better than others. Seems that its reputation is really sky high in that regard. I think it bodes very well for this business.
Did I hear you right there? They've got a fleet of 127, and if they're ordering 148 new planes.
146, yeah, firm orders,
146,
yeah.
sorry.
Yeah, but obviously some of the old ones are going to come off fleet and new ones come on. I think they're
Yeah.
replacing, the fleet's going to be all Airbus A321 Neos, and they're bringing out of circulation some old Boeing 737s. So it's going to be all Airbus fleet. The founder is a former acrobatic pilot and stunt pilot, and he's now stepped down. He was chairman, non-exec chairman. Now he's still on the board, still owns a lot of the shares, Philip Meeson, and he's done a great job with this business. Terrific. But yeah, that's the risk. You've got this big commitment to a lot of new aircraft. They've got a lot of cash. This business got an awful lot of cash. Closed the year with 3.2 billion pounds of cash. A lot of that's customers' deposits.
Okay, yeah.
Even its own cash is 1.3 billion, so it's a great position. But yeah, a lot of that's going to be going out the door on these new planes.
Interesting. That's one of the primary reasons then why it is trading so cheap and why it looks cheap 8 times.
I think a lot of people hate this sector because of its cyclicality. I hope another pandemic doesn't come along anytime soon, but you can see what happens to this sector when you have a downturn. They're being worried about a consumer downturn, but I think their positioning and their price point is great. Everybody wants to go on holiday. I think they'd rather spend money on that than many other, say, semi-luxury items. So people have prioritized that, and they've got a good proposition. This combination, this package holiday combination is good. From my own experience, we've used them. I've used them. My family's used them. It was really good. So yeah, so I think you have cyclicality. The big aircraft order is probably worrying some people. But yeah, isn't a lot of that already in the rating, in the valuation? Pretty modest to us.
Yeah, and as long as the UK economy keeps growing, then people are going to have money in the pockets to go on a holiday, aren't they?
Yeah, there's a tick up as well in, economic growth. Bit of wind in their sails now. People are a bit more confident. All we need is to win the Euros, and we'll be flying. They literally.
Agreed. We're going to keep tying it back to the Euros, aren't we?
Oh,
the
yeah,
podcast.
yeah, absolutely.
What is next week's going to be like if we actually win, Chris? Are we going to just talk about the football for half an hour?
We'll circle back to leisure again, won't we?
Yeah, hotels and airlines, yeah. Yeah, the next company DP Poland. It's the operator for Domino's pizzas in Poland and Croatia. Interesting company.
Yeah, I've heard of it a lot, and it's been a bit of a disaster. And I've never seen it make any money, but it seems to be growing quite well. And Domino's Pizza UK has put in 10 million quid into it in March. It needed a fundraising, raised 20 million, half of which came from Domino's Pizza UK, which has the rights to the UK and has been a super success. Domino's Pizza has been a poster child for. But it started on AIM, it ended up on the main stock market, and it's made a lot of people a lot of money. So they put some money in DP Poland, which, as I say, has been a struggle. But they're growing fast. I mean, 22% growth in system sales in the first half of the year. But this business has never made a bean. Also, if you're thinking of investing in it, you have to assess returns in Polish zloty, euros for Croatia, and then the business itself reports in pounds. So yeah, it's
Some conversions going on there.
All a bit wacky. It's worth the whole business 104 million as well. So you've got a company that's worth over 100 million quid that's never made any money, but seems to be growing fast. Well, 111 stores at the moment. So watch this space. Maybe it'll start turning a profit and demonstrate that things through actual positive financial returns.
Yeah, so I'm presuming, would you like to see cash flow coming through actual cash?
Yeah, and it is positive. Operating cash flow has been positive. Reported profits have been losses. Well, not profits, they've been losses. But it is generating decent operating cash flows. But can it really start producing really strong, positive free cash flow numbers? We'll see.
Is that because they're executing on a strategy of opening stores quickly and that's taking up a lot of cash? Is that the reason why?
So they're expanding, they're using cash flow to support new store openings. And it seems to me that a lot of these are owned stores. So this, unlike Domino's Pizza UK, appears to be not just a franchise rollout, because the revenues of the company are quite close to the system sales revenues, which means that most of the stores seem to be operated by the group, Domino's Pizza, and not simply franchised operations as Domino's Pizza UK is.
I'm not sure what the cultures are over in Poland and Croatia in terms of pizza and in particular takeaway food as well. I mean, the UK economy does love a good takeaway. I'm not sure what it's like in Poland and Croatia.
Yeah, and the concept of chains like that in some countries in Europe, is the concept of a broad-based pizza chain like that. Does it go down well? And I think they tried to do this in Switzerland before, and that's still very much not about chains, and it's more about privately owned, family-run
cafes, restaurants, things like that.
Pizza places,
yeah, independently owned.
Yeah.
Perhaps maybe there's a culture barrier there then that might need a little bit of investigation before one goes too deep into it. So yeah, we move on to the next company, Loungers, the operator of cafe bars and restaurants in the UK.
Yeah, it's a similar theme, really, to continue what we were saying. It's another chain, another group of a chain, which Loungers, it has these three concepts. There's a lounge, Cozy Clubs, that's its other brand, and Brightside. I think we come to that last. But the main brand name is Loungers, and there are these neighborhood cafe bar combining elements of a coffee shop culture and a British pub and dining. They seem to be doing really well as well, growing very fast. Revenue climbed 25% to 353 million. They opened a record 36 sites. And I think they've got 226 lounges, 226 lounges, about another 35 cozy clubs. So yeah, look, it looks an interesting concept. My fear with all of these, and I find a bit sad, is they generally go the way of all of them. They overexpand these places, and it's this formulaic restaurant offering. It's the same sort of thing anywhere you go. They change the name over the door, and they try and make it different. But really, the menu's the same. And what you have, generally speaking, is overexpansion. And they're all a bit tired. And the country's full of tired restaurant chains. Think Harvester or Beefeater and places like they've been around forever, haven't they? And I just find they're a bit tired and ordered. I don't know about you.
There's so many, isn't there, to choose from, as you've said. The barriers to entry are really low. Anyone can open a restaurant or a bar or anything like that. There's no moat in these types of companies, is there?
No, there isn't. They seem to be doing well, in fairness. And what they have, in terms of timing, they're timing things where they're picking up very cheap rents. They're saying that in terms of because the high street has been struggling, they're able to go in and have, there's loads of property available, notably banks, abandoned banks, which are generally quite nice buildings.
Yeah, they are.
Quite nice structures. You'll see a lot of these in basically abandoned banks. And that's been a benefit. And maybe they're a bit more characterful, those kind of buildings as well. So that is a positive. And as I say, they're doing well. As I say, my fear is they'll overexpand. You'll see too many of them. The founders will be long gone by then. They created this concept, would have swanned off and probably sold out to private equity who like to run it for cash flow, and it'll
Yeah.
become tired like the harvesters of this world or some of the others.
Yeah, agreed. And I guess it also ties into the whole economy, isn't it? It's cyclical as well, isn't it? We have a downturn in the economy, they're going to suffer.
Yeah, they are. I find the funniest one is bright side is their new roadside dining concept. I haven't been to one. I'm sure they're very nice. They've opened. They only got 3 of them, I think, or 2 or 3. They seem to hark back to little chefs,
Oh, I remember them.
happy eaters.
Yeah.
I quite like them in their heyday, but not many people are stopping off at these places now, which was why Little Chef went bust several
Yeah,
times.
exactly. Yeah.
Yeah. Maybe they're really good. I must try one. Where's the nearest one? Oh no, it's Saltash near Plymouth. I'm not going down there. Or Honiton, blimey, that's miles away. I've got to go way down to the West Country. I'm not travelling that far to go to a new creation Little Chef.
No, absolutely not. What about visiting the TimeOut in Barcelona?
That's more appealing.
Yes.
Now, TimeOut Group is listed. It's never made a bean as well. It's losses galore. But actually, their concepts I think are quite good. So TimeOut is from the TimeOut magazine, the entertainment media business. And now they've been creating these timeout markets. The first one was in Lisbon. I'm visiting in Lisbon. It's a really nice concept, bit different as well. And they've got lots around the world now. And they've opened the latest one in Barcelona. They're really nifty concepts. The problem was they were pretty capital intensive. They were owning and managing some of these markets. I think now they're only managing some of them. So rather than having to commit too much of their own capital, which they didn't have, as managers, that's not the case. But I'd love to see this business actually start turning a profit because the shares have been a complete disaster up to now. We've never held the shares, I should add. They listed in 2016 at £1.50. They're currently about 50 odd pence. So they haven't done terribly well. The balance sheet reveals that cumulative losses to date of 167 million.
Oof.
Net debt of 28 and lease liabilities of a further 21. However, cash flow's now starting to improve. So hopefully, and clearly they had a terrible time over the pandemic. This business was smashed to pieces. All its venues were closed. But the timeout concept itself, I think, is quite nifty. Market cap's about 188 million. So the business is broadly worth what everybody's plowed into it in terms of money over the years. But yeah, nice concept, a bit different. It does have more of unique selling points. You're going to have one of these in any major city. Can they work? I'd like to see them work because there's been an awful lot of time and effort that's gone into this.
What exactly then do they offer in these market spaces?
Typically, the one in Lisbon I've seen was a huge old market space that has been repurposed to have lots of individual dining and stalls and shops in it. So you can pick your food from whatever, every single variety culture in the world, and then go and eat it at a central dining area, and buy your drinks from different wine cellars. And so lots of different food and drink and beverage offerings and a sort of central eating area as well in quite ambient surroundings as well.
So it's just like the old market days, isn't it?
It is like the old
Are
market.
we circling back again?
Circling back again.
We're bringing back
It's a
Little
sort of
Chef.
retro. It's a retro look, but a bit more controlled and a bit more reliable, shall we say?
Yeah, yeah. So yeah, we're just repeating history.
We are. Well, the end of the building, you can make your heart back of whatever 150 years. This was a stunning market.
Yeah.
And now it's being repurposed for something else.
And shall we move on to a more of what we might coin a modern marketplace? And that's a digital platform that operates still in the travel and leisure industry as we continue that theme in this podcast. And that's a company that you've been a fan of and I think continue to be a fan of, as we'll find out in the next few minutes. And that company is Hostelworld. Are you still a fan of them, Chris?
Yeah, I am. I think it's a great little business. It's an online travel agent, as the name suggests, targeted towards the hostel sector. It now calls itself a social network powered one, which is it's not just sort of gimmickry. It actually has been beneficial to its business model because the problem with any online business is the cost of acquiring customers. A lot of businesses have fallen because it's just cost them too much. We spoke about a business called Gear for Music a few weeks ago. It's an online musical instruments retailer, and it just costs so much to acquire customers who don't return. Hostelworld is embedding this social aspect to it. And the key point about its business, that net bookings were up, applying 9%. It's just put out a trading update, half-year trading update, been driven by more growth in Asia and Central America. Unfortunately, those regions, they're not paying as much, but it's still growing. But it's the cost of acquiring customers is falling. And direct marketing, these are scary numbers, direct marketing as a percentage of revenue has fallen to 45%. Now, that's still staggeringly high.
Yeah, it is.
But 45% is down from 51%, and it was even higher before. So it's been spending huge amounts of money on online marketing. If it can crack that and spend less and less, obviously the margin expansion is terrific, and this is what it appears to be doing. And the proportion of bookings from these social members has increased to 80% from 74% last year. So this is really good news. It's paid off all its debt now. Net debt's peanuts. Was paid off all its residually expensive debt. So I think it's in a really good position.
Yeah, from everything you've described there, the numbers are certainly ticking in the right direction. I can see the concept if they can get to the point where it becomes a prominent social network in this area that they're targeting, then it becomes a self-fulfilling prophecy, doesn't it? The people are coming to the network, not just to network with other travelers, but then to also book their accommodations and who knows what other revenue streams they can bring on as well.
Exactly.
Travel excursions, things like that.
Yeah. And my daughter said the social aspect is good. If you're traveling to a city, you want to know other people there or something, you want to meet up and you're by yourself or a tiny group and you want to meet others, they manage that aspect as well.
Yeah. Avoid this bar, go to this bar.
Yeah.
This is a great nightlife, good food here. All that side of it as well.
With a reliable context, with reliability and credibility, which is really powerful, I think. So, good on them. Another business that struggled, pandemic, awful, debt had risen. They had very costly debt. They've managed themselves through that now, and cash flow is going to be really strong. It's going to be great.
Yeah. Is Fundamental a holder of Hostelworld?
So we hold in general portfolios, and the shares have done well for us over time. Taken a bit of a beating at one point, but we remained patient, and they've done pretty well.
Yeah, patience is a virtue.
Yeah.
And moving on to another company that perhaps could do with a little bit of the success that Hostelworld is now enjoying, but Science in Sports, they've had to raise more cash, haven't they?
Yeah, they put out a load of announcements a few weeks ago. They delayed results, trading updates, and essentially they're under new management now. A new management, the pennies dropped, and they can't just keep growing the revenue line and also growing losses. They were selling more and more. They own two brands, PhD and the Science and Sport brand, and sales have been great, but losses have been mounting. And new management's come in, a new executive chairman, Daniel Wright. He's clearly looked at it and plain as anyone can see that they need to reduce their marketing spend, reduce certain types of customers and focus on profitability. And they've raised 8 million quid at 17 pence a share. It was a small 8% discount of the price beforehand. But that represents about 25%, a quarter of the business. There's big dilution. If you didn't participate in that fundraise, existing shareholders are massively diluted, but clearly they needed it. The interesting thing about this as well is they've initiated a new sort of share scheme for the new management team. Mr. Wright has already acquired 5.88 million shares in the placing at a cost of £1 million. So he's putting his money where his mouth is. So his stake now, equity stake in the business, is 3% odd. He's previously a private equity fellow. Now, if they perform this new management growth scheme, if it delivers a 300% increase in the market capitalization from the current level and market capitalization and share price over 3 years, Mr. Wright could be entitled to shares with a value of 4 million quid, equivalent to about 2.4% of the enlarged share capital. So he's going to do pretty well. Clearly, so are shareholders as general. All shareholders, if the shares go up 300%. He's also agreed to cap his salary at £80,000 for the duration of this growth plan. And other members of the leadership team have also agreed to cap bonus entitlements and everything. I'm not generally in favour of these schemes, but here you have a business that hasn't got any cash. It needs to do something. It needs to shake itself up, and it needs to, otherwise it won't survive. So what do? You need something that isn't going to cost too much money in the short term to incentivize people over the long term. And this growth plan seems to do that. Under the plan, everybody involved in this scheme, the share schemes won't exceed 10%. So they're basically, if this plays out, the maximum paid out is going to be 10% of the share capital. They're going to get 10% for their hard work. And clearly shareholders are also going to do very well. So I don't think it's the worst kind of scheme I've seen. And Mr. Wright, as I said, isn't paying himself a huge amount of money in the meantime.
That's 80,000 a year, is it? Or is that's not a
Yeah.
month, is it?
No, 80,000 a year.
They've certainly looked at Elon Musk's deal, haven't they? And he set off a bit of a trend, it would seem.
Yeah, Elon Musk was even more severe on Elon. I mean, he didn't take any salary.
Yeah, well, that's true, yeah.
He did end up with 40 odd billion at current money value.
He's not got it yet, but
no. He's got to hang around as well, and
Yeah.
he's got to keep the shares. It hasn't even been finally approved, but it's nearly there, I think. Now
it is, yeah.
I don't think this is the worst scheme in the world to try and incentivize a new team to try and drag this business out of the ashes, because it's been a complete disaster. Something needed to be done, and these people seem to, be having a go at it.
You would think with an established brand, well-known, product lines already in place, probably should be achievable.
It should be, but you'd have thought that 2 years ago, 3 years ago,
Yeah,
10 years ago. There's strong brand, but this is a brand. How strong is it? It has never made any money.
Yeah.
Whatever the positioning was. And is it too niche? Is science and sport a bit too niche? Is it only for elite athletes? You're never going to make a brand that valuable if it's too just niche like that. So I think there's some tidying up to do to really drive the numbers in this to prove its value. Clearly not easy, but I think the previous management team would have done it.
Yeah. What sort of experience do they bring in, the new management team?
Well, he's ex-private equity, North Edge Capital. Clearly got made a bit of money in the past. He knows how to look at maybe basket cases and drag them up. Maybe has some capable fellows round him. Yeah, this is a bit of an unusual space. There aren't too many businesses in this space that have made a huge return. Yeah, see how they get on.
Yeah, I definitely want to keep an eye on with a reward structure like that for the management team. They are certainly incentivized to make it work. So worth keeping an eye on. We're going to finish the podcast off with a new listing on AIM, and that's Rosebank Industries. Some have coined Melrose version number 2.
Yeah, it's really excited the stock market. Wow, I can't believe it. So Rosebank Industries is Melrose version 2. Melrose has been a highly successful industrial group run on the structure to buy, improve, and sell. So the founders of Melrose, which originally also listed on AIM, moved to the main stock market and delivered huge returns to shareholders over many years. The 4 members of its management team of Rosebank are ex-Melrose, and they're trying to repeat this Melrose product in Rosebank Industries. It joined AIM, raising, by the way, this is just a concept at the moment, it's just an idea. It joined AIM and raised £50 million at £2.50, and the shares in the day almost doubled to £4. They're up close, I think, £4.80. Concept, yeah. So clearly they're buying into this team's reputation, and so they haven't done a deal yet. This is their fighting fund to start doing deals to help pay for everything.
That's pretty impressive, just based on a reputation, isn't it? It's
not bad, is it?
Incredible.
Not bad. You're already at close to 100 million valuation. Almost doubled, and you haven't really done a deal yet. I assume they've got some targets in mind, and they're going to be returning to the stock market and announcing some deals over the next few months.
And what's your thoughts on it?
I think, again, circling back to that first mention of interest rates, did Melrose itself? Yes, they bought and they improved, but they also bought with cheap debt as well. Was this another? Did they partially benefit from the era of very low cost of money, very cheap money? Money's more expensive now. They're going to put some debt into some leverage into these deals. How's it all going to pan out? It will be interesting to see. But they, as I say, they've got this terrific reputation in the industrial space, and maybe they can do it again. I'm never so sure. It's very few seem to repeat successes. They have one good game or one good sort of career. It's hard to replicate that. In a very different economic environment, a very different interest rate environment as well. So it will be interesting to see how they get on.
Should we leave it there then?
Yeah, probably best. But good to see a new AIM listing. That's positive. Yes. Great news.
Yes. Good news, good news. And hopefully on the next podcast, we'll be celebrating an England win.
Yes, I hope so.
Fingers crossed.
So. With some good football, stylish football.
Oh, I think it's going to have to be stylish against the Spanish, isn't it? Because they're going to play stylish football.
Yeah, it could be interesting. A very interesting game.
See you next week, Chris.
Thanks, Lee. Bye.
Well, that's it for today. Please subscribe for next week's episode, as we will once again discuss global events, the UK share market, and and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.